Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host, and today we're exploring an expert advisor called the Keltner Channel Pullback. This is a trend-aligned mean reversion strategy built around a Keltner-style volatility channel, an ATR-based stop, and a fixed reward-to-risk target. By the end of this video, you'll understand how the channel is constructed, how a trend filter keeps the approach on the right side of the market, and how each position is managed from entry all the way through to exit. Remember, this is educational information only and not financial advice. Let's get started. So what does this expert advisor actually do? At its heart, the Keltner Channel Pullback is a mean reversion approach, but with an important twist. Instead of blindly fading every stretch away from the average, it only fades moves that agree with the underlying trend. That single rule is what separates it from a plain band fade system. Let's talk about the tools it uses. First, it builds a volatility channel. The center line, called the basis, is an exponential moving average of the closing price, using a period of 20 by default. Around that basis, it draws an upper and a lower band, placed a set number of average true range units away, with a default band multiplier of 2. Average true range, or ATR, measures how much the market typically moves, so the bands automatically widen when conditions get busier and contract when things calm down. On top of that channel, the strategy adds a second, slower exponential moving average with a default period of 50. This one never places a trade by itself. Its only job is to act as a directional gate. The market has to be trading on the correct side of this line, and the line itself has to be sloping in that direction before any position is considered. This expert advisor works on a single time frame, reading one completed bar at a time on whatever chart you attach it to. It can be applied to a range of instruments, from currency pairs to indices and metals, since the logic is based on price and volatility rather than any one specific market. Who is this style suited for, in an educational sense? It tends to appeal to traders who prefer a structured, rules-based framework, who are comfortable being patient, and who like the idea of trading only one position at a time with clearly defined risk. As always, trading carries risk, and losses are a normal part of any strategy. Let's walk through the mechanics step by step. On every completed bar, the strategy recalculates three things: the basis line, the two-channel bands, and the slower trend line. It also measures the slope of that trend line by comparing its current value with its value one bar earlier. From there, it defines two market states. An uptrend exists when the most recent close is above the trend line and the trend line is sloping upward. A downtrend exists when the close is below the trend line and the trend line is sloping downward. If neither condition is true, the market is treated as directionless and no new trade is considered. Now the entry logic. For a long, the strategy requires an established uptrend. It then waits for a bar whose low dips below the lower band, but whose close finishes back above that lower band. In plain terms, price stretched down into a discount within the trend, then rejected that level and closed back inside the channel. That rejection, in the direction of the trend, is what the strategy is looking for. The short side is a mirror image. In a confirmed downtrend, it waits for a bar whose high pushes above the upper band, but whose close comes back below it, signaling that the push higher was rejected. Risk is defined the moment a position opens. The stop distance is the average true range multiplied by a stop multiplier, which defaults to 1.5. For a long, the stop sits below the entry by that distance, and for a short it sits above. The take profit is then placed at the reward-to-risk multiple of that same stop distance. With the default reward-to-risk of 1.5, the profit target is 1.5 times as far away as the stop. Finally, there is trade management. Once a position moves 1R in its favor, meaning it has gained a distance equal to its own initial risk, the strategy shifts the stop to the entry price. From that point, the position no longer carries its original downside. Importantly, the expert advisor only ever holds one position at a time and never stacks new orders on top of an open one. Let's read through the code on screen as if we were sitting in MetaEditor. At the top are the input parameters. The BasisEmaPeriod defaults to 20 and the ATR period to 14. The band multiplier of 2 sets how far the bands sit from the basis. The TrendEmaPeriod of 50 drives the directional filter. Below that, The ATR stop-loss multiplier of 1.5 sets the stop distance. The reward to risk of 1.5 sets the target, and lots defines the trade size. Next, the strategy builds the channel. The upper band is the basis plus the band multiplier times ATR, and the lower band is the basis minus that same amount. The slope is simply the trend EMA now, minus its value 1 bar ago. Now look at the two signal lines. A long signal is true only when uptrend is true, and the bar's low is at or below the lower band, and its close is back above that lower band. The short signal is the exact mirror. Downtrend is true, the bar's high reaches or exceeds the upper band, and the close finishes back below it. If the long signal is true, the entry is taken at the ask price. The stop distance is ATR times the stop multiplier. The stop is placed that far below entry, and the take profit is placed at the reward to risk multiple above. The call to trade by sends that order. In the else if block, the short does the same in reverse, taking the bid, placing the stop above and the target below, then calling trade.sell. Let's bring this strategy to life on the chart. You can see the Keltner channel drawn around price, with the upper band and lower band in blue, the basis in the middle in gray, and the slower trend line in gold sitting underneath price. Watch how the whole channel breathes, widening and narrowing as volatility changes. Look at the opening bars on the left. Price is holding above the gold trend line, and that line is gently sloping upward. That combination tells the strategy we are in a confirmed uptrend, so it is only interested in buying pullbacks, never in selling. Now watch the third candle. Price pulls back sharply and its low pierces beneath the lower blue band, dipping into a discount within the trend. But here is the key detail. By the close, price recovers and finishes back above that lower band. The bar rejected the stretch lower and closed inside the channel. Because this happens inside an uptrend, the conditions are met and the buy entry marker appears. The stop is placed just below, at the average true range times the stop multiplier of 1.5, sitting under that rejection low. The take profit is set at the reward to risk of 1.5, meaning the target is 1.5 times as far away as the risk. Follow what happens next. The following candles push higher, one after another, riding up along the basis line. As price advances by a distance equal to the initial risk, the strategy quietly slides the stop up to the entry price, so the position no longer carries its original downside. Price then continues to climb until it reaches the take profit target, and the long trade is closed at the first take profit marker. A clean, trend-aligned pullback, captured and completed. Now the character of the market changes. Notice how price rolls over near the 7th and 8th candles, then slips below the gold trend line, and the trend line itself begins to slope downward. That flips the strategy's bias. We are now in a confirmed downtrend, so it will only look to sell rallies back into the upper band. Watch the 11th candle closely. Price snaps upward, and its high pushes above the upper blue band, testing that stretched level. But by the close, price is rejected and finishes back below the upper band, right in line with the falling trend. That is the mirror image of our earlier setup, and the sell entry marker appears. This time the stop sits just above the rejection high, again at ATR times the stop multiplier, and the take profit is projected below at the same reward to risk of 1.5. From there, follow the candles down. Price steps lower, back toward and beneath the basis, and once the trade has traveled 1 hour, the stop is moved to break even just as before. Price keeps sliding until it reaches the lower take profit target, and the short trade is closed at the final marker. In both cases, notice the common thread. The strategy waited for a stretch to the far band, waited for that stretch to be rejected back inside the channel, and only acted when the move agreed with the trend. That discipline is the whole idea behind this approach. And that brings us to the end of our look at the Keltner Channel Pullback Expert Advisor. We covered how the volatility channel is built from an EMA basis and ATR bands, how the slower trend line acts as a directional filter, and how the strategy only fades a stretch to the far band when price rejects that level in the direction of the trend. We also walked through the ATR-based stop, the fixed reward to risk target, and the automatic move to break even once a trade travels 1 hour. If you found this breakdown helpful, please give the video a like, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like us to examine next. You can find more educational content over at www.algobot.live. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Past performance does not guarantee future results. Trade responsibly.